Question 1. What is a primary characteristic of fixed annuities? A. They provide a variable return based on market performance. B. They offer a guaranteed rate of return that is set for the term of the contract. C. They allow the policyholder to invest in equity securities for higher returns. D. They are generally used to fund estate planning strategies. Answer. B. They offer a guaranteed rate of return that is set for the term of the contract. Explanation. Fixed annuities offer a guaranteed rate of return for the term of the contract, providing a predictable income stream during the distribution phase. Unlike variable annuities, which are influenced by market performance, fixed annuities offer more security and stability. This makes them an attractive option for individuals seeking reliable income, particularly during retirement. The guaranteed return is set when the contract is issued, and the annuitant's principal is protected against market fluctuations. Question 2. Scenario. Mr. Edwards is 62 years old and is considering purchasing a fixed annuity for his retirement. He is evaluating whether he should choose a fixed immediate annuity or a deferred fixed annuity. Mr. Edwards intends to start receiving income from the annuity immediately upon purchase. Based on his needs, which annuity type would be the most appropriate for him? A. Fixed immediate annuity. B. Fixed deferred annuity. C. Variable immediate annuity. D. Variable deferred annuity. Answer. A. Fixed immediate annuity. Explanation. Since Mr. Edwards is looking to start receiving income immediately upon purchase, the most suitable choice for him is a fixed immediate annuity. This type of annuity begins paying out income right after the purchase, providing him with an immediate income stream. Fixed deferred annuities, on the other hand, delay income payments until a future date, which would not meet Mr. Edwards' needs in this case. The other options, variable immediate and deferred annuities, introduce investment risks tied to market performance, which may not align with his preference for stability and retirement income. Question 3. How does the taxation of an annuity differ when the contract is purchased within a qualified retirement account, such as an IRA? Annuity withdrawals from a qualified account are tax-free after age 591. B. Annuity withdrawals from a qualified account are taxed as ordinary income. C. Annuity withdrawals from a qualified account are taxed at a fixed 10% rate regardless of income. D. Annuity withdrawals from a qualified account are subject to capital gains tax rates. Answer. B. Annuity withdrawals from a qualified account are taxed as ordinary income. Explanation. Annuities purchased within qualified accounts such as IRAs or 401ks are subject to ordinary income tax upon withdrawal. This is because the funds in these accounts have already been contributed on a pre-tax basis. When the annuity payouts are made, the withdrawals are taxed at the individual's regular income tax rate. There are no capital gains tax implications for annuity withdrawals from qualified accounts, and early withdrawals before age 591 are subject to a 10% penalty in addition to income tax. Question 4. Which of the following statements accurately describes the role of an annuity rider? A. A rider guarantees the payment of a death benefit to the annuitant's beneficiary, regardless of the account value. B. A rider allows the annuitant to access a lump sum of money at any time free from penalties. C. A rider ensures that the annuity will grow at a fixed, predetermined rate of return over time. D. A rider adds additional income options, such as long-term care benefits or a guaranteed minimum income benefit. Answer. D. A rider adds additional income options such as long-term care benefits or a guaranteed minimum income benefit. Explanation. Riders are additional provisions added to an annuity contract that provide extra benefits or options. For example, a long-term care rider or a guaranteed minimum income benefit rider can enhance an annuity's value by offering income security or covering specific needs. These riders come at an additional cost and can be added at the time of purchase. Option is incorrect because riders related to death benefits may vary, but not all guarantee a death benefit. Option B is incorrect as riders do not guarantee free access to lump sums. Option C is incorrect because riders do not typically guarantee a fixed rate of return on the annuity. Question 5. What is the tax treatment of interest earned in a non-qualified annuity during the accumulation phase? A. The interest is subject to ordinary income tax as it is earned, regardless of withdrawal. B. The interest is tax deferred until withdrawn, at which point it is subject to ordinary income tax. C. The interest is taxed as capital gains when withdrawn. D. The interest is tax exempt during the accumulation phase, with no taxes upon withdrawal. Answer. B. The interest is tax deferred until withdrawn, at which point it is subject to ordinary income tax. Explanation. In a non-qualified annuity, the interest earned during the accumulation phase is tax-deferred, meaning it is not taxed until it is withdrawn. Once withdrawn, the earnings interest are taxed as ordinary income, not capital gains. This is a key feature of annuities, as they allow the annuitant to defer taxes on the investment growth until it is actually taken out. Option A is incorrect because taxes are not paid as the interest is earned. Option C is incorrect because annuity withdrawals are taxed as ordinary income, not capital gains. Option D is incorrect because interest in non-qualified annuities is never tax exempt. Question 6. Scenario. Mrs. Adams, a 45-year-old investor, has been advised to purchase an annuity as part of her retirement strategy. After reviewing several options, she is concerned about the possibility of needing to withdraw funds before reaching retirement age. Which of the following options would most likely allow Mrs. Adams to access some of her funds without a significant penalty? A. A deferred annuity with a 10-year surrender period. B. A fixed annuity with a high participation rate. C. A variable annuity with an optional free withdrawal rider. D. An equity indexed annuity with a cap rate feature. Answer. C. A variable annuity with an optional free withdrawal rider. Explanation. A variable annuity with an optional free withdrawal rider allows the annuitant to access a portion of their funds, typically up to a certain percentage like 10% per year, without incurring surrender charges or early withdrawal penalties. This option is particularly suitable for individuals like Mrs. Adams, who may need access to their funds before the full annuitization or distribution phase. Option A is incorrect because deferred annuities generally have long surrender periods and early withdrawals during this period incur penalties. Option B does not address the need for flexible withdrawals, and Option D does not focus on withdrawal flexibility but rather on the annuity's potential return based on market performance. Question 7. What does the participation rate in an equity indexed annuity determine? A. The percentage of the account value that is guaranteed to be credited annually. B. The percentage of any market gain that will be credited to the annuity subject to a cap. C. The total amount of premiums that the policyholder must invest to receive payouts. D. The percentage of the annuitant's income that is guaranteed during the payout phase. Answer. B. The percentage of any market gain that will be credited to the annuity subject to a cap. Explanation. The participation rate in an equity indexed annuity determines the percentage of the index's gain that is credited to the annuity's account, typically subject to a cap rate. For example, if the participation rate is 80% and the market index grows by 10%, the annuity's value would increase by 8%. If a cap is in place, it limits the maximum return regardless of the index's performance. The other options are incorrect because they do not relate to the calculation of credited interest based on market performance. Question 8. Which of the following is true about the free look period in Nebraska annuity contracts? A. It allows the annuitant to cancel the contract for a full refund within 30 days of purchase. B. It only applies to fixed annuity contracts, not variable annuities. C. It applies only if the annuity is purchased by a resident of Nebraska. D. It allows the annuitant to exchange one annuity for another without any fees. Answer A. It allows the annuitant to cancel the contract for a full refund within 30 days of purchase. Explanation. The free look period is a consumer protection provision that allows an annuitant to cancel the contract within a set period, typically 30 days, and receive a full refund of the premiums paid. This period provides the consumer time to review the contract terms and decide if they are satisfied with the annuity. Option B is incorrect because the free look period applies to all types of annuities. Option C is incorrect because the free look period applies to all annuity contracts, regardless of the state of purchase, although some states may extend this period beyond 30 days. Option D is incorrect because the free look period does not apply to exchanges between annuities, but rather to cancellations. Question 9. What is the primary risk associated with investing in a variable annuity? A. The annuitant's premiums are not guaranteed to grow in value. B. The annuity's death benefit is capped by the insurance company. C. The annuitant must pay taxes on withdrawals regardless of age. D. The annuity's payouts are fixed and cannot increase with inflation. Answer A. The annuitant's premiums are not guaranteed to grow in value. Explanation. The primary risk of investing in a variable annuity is that the annuitant's premiums are subject to market risk, meaning their value can fluctuate depending on the performance of the underlying investment options. Unlike fixed annuities, which provide a guaranteed rate of return, variable annuities can experience both gains and losses. Option B is incorrect because the death benefit is typically guaranteed but may have limitations based on the contract. Option C is incorrect because withdrawals from variable annuities are generally subject to ordinary income tax, but the age-related penalties only apply to early withdrawals. Option D is incorrect because the payouts from a variable annuity can increase or decrease based on the performance of the investments. Question 10. Which of the following is the primary characteristic of a life-only annuity option? A. The annuity will pay a fixed monthly income for the annuitant's lifetime, but payments will stop upon death. B. The annuity will pay a fixed monthly income for the annuitant's lifetime, but payments continue to the beneficiary after the annuitant's death. C. The annuity will pay a fixed monthly income for a set number of years even if the annuitant dies before the term ends. D. The annuity will pay a fixed monthly income for the annuitant's lifetime and payments will increase annually. Answer A. The annuity will pay a fixed monthly income for the annuitant's lifetime, but payments will stop upon death. Explanation. A life-only annuity is a type of annuity where the annuitant receives regular payments for the duration of their life, but the payments stop upon the annuitant's death. This option provides the highest monthly payment since there are no provisions for continuing payments to a beneficiary after death. Option B describes a joint and survivor annuity. Option C describes a period-certain annuity. Option D describes an inflation-adjusted annuity, which is not typical of a life-only option. Question 11. Which of the following is an advantage of purchasing a fixed annuity? A. The annuity's value is directly tied to the performance of the stock market. B. The annuitant's principal and interest are guaranteed to grow at a fixed rate. C. The annuity offers flexible premium payments with no surrender charges. D. The annuitant can withdraw unlimited funds without penalties. Answer B. The annuitant's principal and interest are guaranteed to grow at a fixed rate. Explanation. A fixed annuity guarantees a set interest rate, ensuring the annuitant's principal and interest grow at a predetermined rate, offering stability and predictability. This is the primary advantage of fixed annuities compared to variable or equity-indexed annuities, which are subject to market performance. Option A is incorrect because fixed annuities are not tied to the stock market. Option C is incorrect because fixed annuities may still have surrender charges. Option D is incorrect because fixed annuities have withdrawal limits and penalties for early withdrawals. Question 12. Scenario. Mr. Harris, a 60-year-old retiree, is considering purchasing an annuity with a guaranteed minimum income benefit rider. Which of the following would most likely benefit Mr. Harris the most from this rider? A. It guarantees a fixed rate of return regardless of market performance. B. It ensures a minimum monthly income even if the underlying investments lose value. C. It allows unlimited access to the annuity funds without penalties. D. It provides a death benefit to the beneficiary based on the original premium paid. Answer B. It ensures a minimum monthly income even if the underlying investments lose value. Explanation. A guaranteed minimum income benefit (GMIB) rider guarantees that the annuitant will receive a minimum income regardless of the performance of the underlying investments. This rider is especially beneficial for retirees like Mr. Harris who want income stability even in volatile market conditions. Option is incorrect because the GMIB is not focused on guaranteeing a fixed rate of return. Option C is incorrect because access to funds is typically subject to penalties unless a specific rider allows penalty-free withdrawals. Option D describes a death benefit, not a GMIB rider. Question 13. Which of the following factors is least important when determining the annuitant's monthly payment for a fixed annuity? A. The amount of the initial premium. B. The annuitant's age at the time of purchase. C. The length of the payment period chosen, life or fixed term. D. The performance of the underlying investment options. Answer D. The performance of the underlying investment options. Explanation. Fixed annuities provide guaranteed payments, so the performance of the underlying investment options does not affect the monthly payments. The key factors in determining the monthly payment are the initial premium, the annuitant's age, since older individuals generally receive higher monthly payments, and the length of the payment period chosen, such as a life-only option or a term-certain option. Option D is incorrect because the performance of underlying investments is irrelevant in fixed annuities, unlike variable annuities. Question 14. What does the surrender charge on an annuity refer to? A. A fee for the privilege of accessing annuity funds before the specified withdrawal age. B. A tax penalty for withdrawing funds from the annuity before reaching retirement age. C. A penalty for withdrawing funds during the early years of the contract, usually a percentage of the withdrawal. D. A fee charged by the annuity provider for processing the annuity payout at the end of the contract term. Answer. C. A penalty for withdrawing funds during the early years of the contract, usually a percentage of the withdrawal. Explanation. A surrender charge is a penalty applied if the annuitant withdraws funds from the annuity during the early years of the contract. This charge is typically a percentage of the amount withdrawn and decreases over time, eventually disappearing after the surrender period ends. Option is incorrect because a surrender charge is not a fee for early access but rather a penalty for early withdrawals. Option B is incorrect because tax penalties are separate from surrender charges. Option D is incorrect because the surrender charge is not related to processing the payout. Question 15. Which of the following best describes an equity-indexed annuity? A. An annuity that credits interest based on the performance of a stock market index, subject to a cap and a participation rate. B. An annuity that provides a fixed interest rate regardless of market performance. C. An annuity that guarantees a fixed payout for the duration of the annuitant's life with no options for growth. D. An annuity that allows the annuitant to invest in various stock and bond funds for potential growth. Answer A. An annuity that credits interest based on the performance of a stock market index, subject to a cap and a participation rate. Explanation. An equity-indexed annuity links its interest credits to the performance of a specific stock market index, such as the S&P 500, with both a cap, the maximum rate of return, and a participation rate, the percentage of the index gain that is credited to the annuity. This option offers some potential for higher returns compared to fixed annuities, but with less risk than variable annuities. Option B describes a fixed annuity, while option C describes a life-only annuity. Option D describes a variable annuity, not an equity-indexed annuity. Question 16. What is the primary risk of investing in a variable annuity? A. The annuitant's monthly payments are guaranteed regardless of market conditions. B. The annuitant can lose money due to the performance of the underlying investment options. C. The annuitant can make unlimited withdrawals without incurring penalties. D. The annuity's payout is fixed and cannot increase with inflation. Answer. B. The annuitant can lose money due to the performance of the underlying investment options. Explanation. The primary risk of a variable annuity is that the value of the annuity is tied to the performance of the underlying investment options, typically mutual funds. If the investments perform poorly, the annuitant's account value and eventual payouts can decrease. This is in contrast to fixed annuities, where payments are guaranteed. Option is incorrect because variable annuities do not guarantee fixed monthly payments. Option C is incorrect because variable annuities have withdrawal limits and penalties. Option D is incorrect because variable annuities offer the potential for growth, unlike fixed annuities. Question 17. What is a guaranteed minimum withdrawal benefit? A rider that guarantees the annuitant will receive regular income withdrawals based on the account balance, regardless of market performance. B. A rider that guarantees a minimum death benefit based on the initial premium. C. A rider that allows the annuitant to withdraw a set percentage of the account value each year, with no cap. D. A rider that guarantees the annuitant will receive a fixed monthly income regardless of market performance. Answer A. A rider that guarantees the annuitant will receive regular income withdrawals based on the account balance, regardless of market performance. Explanation. The GMWB rider guarantees the annuitant a minimum level of income withdrawals, regardless of the performance of the underlying investments in the annuity. This provides security in retirement, even if the account balance declines due to poor investment performance. Option B describes a different type of rider, and options C and D do not specifically relate to the guaranteed minimum withdrawal benefit. Question 18. Which of the following is an advantage of a fixed annuity over a variable annuity? A. Fixed annuities provide high returns based on stock market performance. B. Fixed annuities offer the potential for higher income payments as investments perform better. C. Fixed annuities offer predictable, guaranteed returns with no exposure to market risk. D. Fixed annuities provide more flexible withdrawal options than variable annuities. Answer. C. Fixed annuities offer predictable, guaranteed returns with no exposure to market risk. Explanation. Fixed annuities provide predictable and guaranteed returns, which means the annuitant's principal and interest are secure and unaffected by market fluctuations. This is a key advantage over variable annuities, which are subject to the performance of the underlying investment options and can fluctuate in value. Option A is incorrect because fixed annuities do not depend on stock market performance for returns. Option B is incorrect because variable annuities, not fixed annuities, offer the potential for higher income based on market performance. Option D is incorrect because fixed annuities generally have less flexibility in withdrawals compared to variable annuities, which may offer more options for accessing funds. Question 19. Which of the following is true about the tax treatment of annuities? A. The principal invested in an annuity is subject to tax when it is withdrawn. B. The earnings interest in an annuity are taxed when the annuity is purchased. C. Earnings in an annuity are taxed as ordinary income when withdrawn. D. Annuities are not subject to taxes until the annuitant turns 65. Answer C. Earnings in an annuity are taxed as ordinary income when withdrawn. Explanation. Annuities are tax-deferred products, meaning that the earnings, interest, or investment gains are not taxed until they are withdrawn. When the annuitant starts taking distributions, the earnings are taxed as ordinary income. Option is incorrect because the principal original investment is not taxed when withdrawn. Only the earnings are. Option B is incorrect because earnings are not taxed when the annuity is purchased, but rather when they are withdrawn. Option D is incorrect because there is no age requirement for taxes on annuities. The taxes apply when withdrawals are made, not based on the annuitant's age. Question 20. What is the primary benefit of a joint and survivor annuity option? A. It guarantees payments to the annuitant for a set number of years, even if both annuitants die. B. It guarantees payments to both annuitants for their lifetimes, with the survivor continuing to receive payments after the other dies. C. It provides a higher monthly payment than a single life annuity. D. It allows the annuitant to change the beneficiary at any time without restriction. Answer. B. It guarantees payments to both annuitants for their lifetimes, with the survivor continuing to receive payments after the other dies. Explanation. A joint and survivor annuity ensures that both annuitants receive payments for life, and if one annuitant dies, the surviving annuitant continues to receive payments. This option provides ongoing income for both parties, offering financial security for the surviving partner. Option is incorrect because joint and survivor annuities continue payments only to the survivor, not to both after both annuitants die. Option C is incorrect because joint and survivor annuities generally provide a lower monthly payment than a single life annuity due to the additional guarantee. Option D is incorrect because, in the joint and survivor annuity, the beneficiary options are generally predetermined and cannot be changed without restrictions. Question 21. Which of the following best describes a period certain annuity? A. An annuity that pays a fixed income for a set period, regardless of whether the annuitant is alive. B. An annuity that pays income for the annuitant's lifetime, with payments ceasing at death. C. An annuity that provides income for a fixed period, with payments continuing to a beneficiary if the annuitant dies. D. An annuity that pays income only for a set number of years, with no payments made after the period ends. Answer A. An annuity that pays a fixed income for a set period, regardless of whether the annuitant is alive. Explanation. A period certain annuity provides guaranteed payments for a specific period, e.g., 10 years, regardless of whether the annuitant is alive during the entire period. If the annuitant dies before the period ends, the beneficiary will continue to receive the payments for the remaining time. Option B describes a life-only annuity. Option C is incorrect because while a period certain annuity continues payments to a beneficiary after death, the definition emphasizes the fixed period of payments. Option D is incorrect because it describes an annuity that ends once the fixed period expires. Question 22. What is the main disadvantage of purchasing an annuity with a long surrender period? A. The annuitant will pay higher taxes on the income received. B. The annuitant has less flexibility in accessing their funds during the surrender period. C. The annuity's returns are based on market performance, which is unpredictable. D. The annuity has a low payout due to the long surrender period. Answer. B. The annuitant has less flexibility in accessing their funds during the surrender period. Explanation. Annuities with long surrender periods impose penalties if the annuitant withdraws funds early. This limits the flexibility of accessing funds and may reduce the annuitant's ability to respond to unexpected financial needs. Option is incorrect because taxes are based on withdrawals, not directly on the surrender period. Option C is incorrect because surrender periods do not directly affect market performance. Option D is incorrect because a long surrender period does not inherently lead to low payouts, though early withdrawals during that period could be subject to penalties. Question 23. What is a death benefit in the context of an annuity? A. A payout to the beneficiary if the annuitant dies, typically equal to the account value or premium paid. B. The amount of income the annuitant will receive after a death benefit is paid to a beneficiary. C. The minimum guaranteed payout to the annuitant after the annuity contract ends. D. A one-time payment made to the annuitant as, regardless of the annuity type. Answer A. A payout to the beneficiary if the annuitant dies, typically equal to the account value or premium paid. Explanation: a death benefit ensures that if the annuitant dies before receiving total payments equal to or exceeding the premiums paid, the beneficiary will receive a payout usually equal to the account value or the amount of premiums paid. This provides protection for the annuitant's heirs. Option B is incorrect because death benefits are for beneficiaries, not for income payments to the annuitant after death. Option C is incorrect because it refers to a minimum payout, not a death benefit. Option D is incorrect because death benefits are tied to specific annuity contracts, not a general one-time payment. Question 24. Which of the following is a feature of an annuity with a cost of living adjustment COLA rider? A. The annuity provides a fixed income with no adjustments for inflation. B. The annuity's payouts are adjusted for inflation, typically in line with a specified index. C. The annuity guarantees a higher monthly payment based on market performance. D. The annuity provides a one-time lump sum payout upon retirement. Answer B. The annuity's payouts are adjusted for inflation, typically in line with a specified index. Explanation: a cost of living adjustment COLA rider increases the annuity's payments over time, usually based on an inflation index like the Consumer Price Index (CPI). This helps protect the purchasing power of the annuity income as inflation rises. Option A is incorrect because the COLA rider ensures that payments are adjusted for inflation. Option C is incorrect because COLA riders do not rely on market performance but on inflation adjustments. Option D is incorrect because the COLA rider adjusts income over time, not a one-time lump sum. Question 25. Which of the following is true about a fixed index annuity? A. It offers guaranteed returns based on the performance of a specific stock market index. B. It allows for unlimited market gains without any risk of loss. C. It provides a fixed interest rate and does not rely on market performance. D. It offers a return that is linked to a stock market index but with a guaranteed minimum return. Answer D. It offers a return that is linked to a stock market index but with a guaranteed minimum return. Explanation: a fixed index annuity offers returns based on the performance of a specific market index like the S&P 500 but also includes a guaranteed minimum return, ensuring the annuitant is protected from market downturns. Option A is incorrect because returns are linked to the index but are not guaranteed based solely on the index's performance. Option B is incorrect because there are limits to the gains and the annuity does carry some risk but not to the principal. Option C is incorrect because it describes a fixed annuity, not a fixed index annuity. Question 26. What is a primary advantage of a deferred annuity? A. Immediate access to the invested funds without penalty. B. The ability to grow the investment tax deferred until withdrawals begin. C. Higher payouts due to immediate annuitization. D. Payments begin immediately, providing a steady income stream. Answer B. The ability to grow the investment tax deferred until withdrawals begin. Explanation: a deferred annuity allows the annuitant to invest money and let it grow tax deferred until they begin making withdrawals, usually after a set number of years or upon reaching a certain age. This provides tax advantages compared to taxable investments. Option A is incorrect because deferred annuities do not allow immediate access to funds without penalties. Option C is incorrect because higher payouts are typically associated with immediate annuities, not deferred ones. Option D is incorrect because deferred annuities do not provide income immediately. Payments are delayed until the deferral period ends. Question 27. Which of the following types of annuities provides payments for a fixed period of time, regardless of the annuitant's life? A. Life annuity. B. Period certain annuity. C. Variable annuity. D. Joint and survivor annuity. Answer B. Period certain annuity. Explanation: a period certain annuity guarantees payments for a specific period such as 10 or 20 years, regardless of whether the annuitant is still alive during that time. If the annuitant dies before the end of the period, the remaining payments go to a beneficiary. Option A is incorrect because a life annuity provides payments for the annuitant's lifetime, not for a fixed period. Option C is incorrect because of variable annuities payments depend on the performance of underlying investments. Option D is incorrect because a joint and survivor annuity provides lifetime payments to both annuitants and continues to the surviving annuitant, not a fixed period. Question 28. Which of the following is typically not a feature of an annuity with a guaranteed minimum withdrawal benefit to divide A? The annuitant is guaranteed to receive a certain amount of income each year. B. The annuitant can withdraw from the account up to a guaranteed percentage, even if the account balance is insufficient. C. The annuity's payout is determined by market performance with no guaranteed minimum. D. The annuitant is protected from market downturns with a guaranteed withdrawal amount. Answer: C. The annuity's payout is determined by market performance with no guaranteed minimum. Explanation: an annuity with a guaranteed minimum withdrawal benefit rider offers the annuitant the ability to withdraw a minimum amount each year, regardless of the market performance, providing protection against market downturns. Option C is incorrect because the key feature of the GMWB rider is a guaranteed withdrawal, not one determined by market performance. Options A, B, and D are correct because they describe how the GMWB rider ensures a minimum level of income for the annuitant even if the account value decreases due to market conditions. Question 29. What does annuitization of an annuity refer to? A. The process of transferring the annuity's value into another investment vehicle. B. The decision to receive income payments over a specified period or lifetime. C. The withdrawal of the annuity's entire balance as a lump sum. D. The conversion of the annuity into a life insurance policy. Answer: B. The decision to receive income payments over a specified period or lifetime. Explanation: annuitization is the process by which the annuity's value is converted into periodic income payments either for a specified period or for the annuitant's lifetime. This is the point at which the annuity transitions from an investment vehicle into a source of regular income. Option A is incorrect because annuitization involves receiving periodic income, not transferring the annuity's value elsewhere. Option C is incorrect because withdrawing the full amount as a lump sum is not annuitization but a cash surrender. Option D is incorrect because annuitization does not involve converting the annuity into life insurance. Question 30. Which of the following is a potential disadvantage of a variable annuity? A. The annuitant has a guaranteed return regardless of market performance. B. The annuitant is subject to the performance of the underlying investment options, which can cause value fluctuations. C. The annuitant cannot access the funds until a specific age. D. The annuity has a fixed payout that does not change over time. Answer: B. The annuitant is subject to the performance of the underlying investment options, which can cause value fluctuations. Explanation: a variable annuity's value is based on the performance of the investment options selected, which means the annuitant is exposed to market risk. The value of the annuity can fluctuate, which can lead to lower payouts. Option A is incorrect because variable annuities do not offer guaranteed returns as they are dependent on market performance. Option C is incorrect because variable annuities do not necessarily restrict access to funds until a certain age, though there may be penalties for early withdrawals. Option D is incorrect because the payout amount in a variable annuity can change depending on investment performance.